Hey, so in this video, I'm going to show you our commercial office acquisition template. So this template is built specifically for folks that are looking to acquire an existing commercial office building or industrial building and perhaps implement renovations or a new operations team that will hopefully improve the property. Maybe you'll be able to increase rent rates, improve the net operating income of the property, and then provide a return to investors. And so I'm going to walk through this template in quite a bit of detail. I'm going to first kind of give you a high level view just so you can see what's in the template before you dive into all of the details, and then really dive into show you how to fill it out. Before I do that, just a couple things. One, we'll put a link to this template in the description of the video below. Secondly, if you stick around to the end of the video, we'll give you access to a coupon code. As a thank you for sticking around and watching the whole video, we'll give you access to a coupon code that you can use to get a discount on the template. And then the last thing, I just thought give you a little bit of my background. So I spent about a decade working as an SBA lender, a small business administration lender. And while I was there, I had a lot of clients that were working on financial projections, or we were asking clients for financial projections for their loan application. Clients were having trouble. And so I thought, I should build like a TurboTax type solution for financial projections. And so I gave my brother a call, who's a software engineer, and said, hey, let's build this thing together. And so we built this web app to try to help clients create financial projections. And we fought this good fight. We thought we really wanted to build this, monthly recurring revenue business that customers would pay for each month to help with their projections. And it turns out business owners need projections for a single point in time when you're trying to raise capital from lenders and investors. You don't want to pay for it monthly. Also, it turns out that Excel is still really good. And so we fought the long fight trying to make the software thing work and realized, templates, Excel templates, spreadsheet templates are still a really good solution for financial modeling. And so we kind of pivoted, and what we do today is we have a CPA on our team, and we build out custom financial projection templates for all sorts of different industries and businesses. We have about 100 different industry specific templates. And particularly today, we're looking at this commercial office acquisition and renovation template. So with that bit of background, I wanted to give you, I thought we'll go ahead and dive into this tool. Okay, so this is our at a glance tab. And this is a kind of, once you finish the entire process, you'll have some nice graphs, charts, key ratios and numbers that you might be able to put in a business plan or presentation to potential investors. You also will get a 10-year cash flow summary, a 10-year balance sheet summary, a 10-year income statement summary. Then you also get this cool table here. This is a pre and post acquisition comparison. And so again, the idea is that you probably be acquiring this existing business, and your thesis would be that, hey, we can operate this better. Otherwise, you probably wouldn't want to acquire it. So this will allow you to see, here's how the property was operating prior, and the 12 months prior. And then here's how it's going to operate. Here's the net operating income and cash flow on the property after we've implemented renovations and our process and stabilized the property. So this is looking at months 17 to 28 in this example after stabilization. So I think that can be pretty useful. Then we also have the cash flow statement, balance sheet, and income statement all broken down by month for all 10 years. So if you need the monthly detail, maybe overkill for most, but we have that monthly detail there as well. The last thing I wanted to show you here, and we may look at this in a bit more detail towards the end, but this is our distributions tab. And so that gives you the ability to kind of visualize cash flow at a high level. And then you can put in what percentage of your cash do you want to hold in reserve versus what percent do you want to distribute to investors. So you can have the ability to distribute some percentage of your cash reserve over time, which would ultimately impact the returns for the investors as well. We also see here that you can enter in sale assumptions. So you can say, okay, we're going to sell this property in year 10, and at this 7% cap rate is what we're assuming. So based on those assumptions and the net operating income at that time, we think we can get a sale price of $15.9 million. We're expecting to still have $6.5 million in debt. So we'll have net sale proceeds of 9.4. And we'll ultimately be able to distribute that to investors, to the investors. And so here, ultimately, we can see here's our IRR after the sale and cash on cash returns and various investor return metrics here. Now, if you need a more customized like waterfall model for distributions, I know this is pretty straightforward and simple. If you need something a bit more complex, of course, we can customize that for you as needed. So feel free to reach out to us at support@projectionhub.com and we can help with that. Okay, so how do we get all these reports in the first place? We have to do some work on the input side. So I'm going to jump over to our input tabs here. So we're going to start with our input revenue tab. And we're saying, here's the projection start month. So we're acquiring the property in January of 2024. And we've got here the different units. We've got a lower floor, an upper floor, and an annex. And we can put in the number of units and the square footage of each unit. And we can also put in the new forecasted rent. So you can see here, we were charging $25 a square foot for the lower floor. We're going to bump that up to 30 with our after acquisition. So this is what the current owners were charging, and then this is what we're going to charge. And then we also have the ability to say, hey, you know what? It's going to take some time for us to increase rent. So it's not going to happen immediately. So we're saying, okay, we're going to maybe do renovations over a period of time. And once those renovations are done, we're going to start increasing rents. Or perhaps, maybe the current property is just below market rate and you're going to increase rents right away. You could put month 1 in here. In this example, we said, okay, we're going to increase the lower floor rents on month 11. And it's going to take us 6 months after we start increasing rents. It's going to take us 6 months to actually get everybody's lease moved over to the new rental rate. The one last thing I wanted to mention here is that you have the ability to kind of say, okay, we have the annex here and then we renovated it and we were able to add 200 square feet of leasable space. And so by putting in the annex here, we can say, okay, yep, we had 3,000 square feet at $23 a foot prior to acquisition, but then it goes to 0. So we were saying 0 rent for this in the future because instead we are adding this renovated annex, which is 3,200 square feet, had no rent prior, but it's going to be at $28 a square foot in the future. So just wanted to show you that example of how that could work. Now you also have the ability to add in additional revenue per unit per month here. So I've got an example of miscellaneous fees. Maybe these are common area maintenance fees or something like that. If you charge for parking or internet storage, those sorts of things, you could add those additional revenue items in there as well. Now you have the ability down here to apply an annual rent increase. So we've set that at 4%. You can apply the vacancy rate. So we're saying the prior owners had a 12% vacancy. We're going to drive that down over time. Year 1, we think we'll be at 11, then 10, and then we'll stabilize at 10. You can also set what percentage of tenants are going to pay for those other additional revenue fees. So we're saying 100% of our tenants are going to pay that additional $250 a month because that's a required common area maintenance in our example. But maybe you'd say, okay, 10% are going to pay for an extra parking fee or something like that. Okay, so that's it really on the revenue side. You have this one last other operating income. You could just add in additional revenue that way. Moving on to our operating expense tab here. We'll want to input our different operating expenses and you can categorize these. So you can apply these 10 categories here. So you can select from this drop down from these different categories, and then you can apply a different cost driver. So you have a few different options of what the cost driver could be. It could be on a per unit basis, so like a per office space or tenant basis, or a per square foot, or an expense could be applied to the entire property. And so a couple of examples here we have for landscaping. So we're going to say this landscaping applies to the entire property, but we only have to pay certain months of the year because this is for lawn care and the grass doesn't grow all year. And so from month 4 to month 10, we're going to pay $2,000 a month, and it's going to repeat each year. The grass is going to grow every year. So that's an example of how you can kind of manipulate these different assumptions here. Now you could also have expenses on a per unit basis. So let's say we have water that is not covered by the tenants. This is just going to be we have a small water bill that we're expecting $2 per month per unit that is not covered by the tenants. So you can set that on a per unit basis. Now you can also set a per square foot expense. So maybe we have a budget for our interior maintenance of 9 cents per square foot. And so you can set that as well. One last thing I'll show you here is if you want to say, okay, we have a certain expense that hits in one particular month each year. That would be like real estate taxes here. We could say, okay, on a per unit basis, we're going to pay $4,000 per unit, or it might make more sense to make this an entire property expense, but it's going to hit in month 4. So we set month 4 as the first payment and the last payment. Then we select yes from this dropdown to say, yep, it's going to repeat every year. And the 4th month of the year, we're going to have our real estate taxes. And you can apply these annual growth rates to the expenses here as well. Okay, and so this section is really cool and useful for comparison. So this grayed out section, this is your calculated forecasted expense amount based on all the assumptions you entered in over here in this table. So for example, if we said we're going to pay $2 in water per unit, that amounts to $240 for the whole year. We're going to pay 9 cents per square foot, and that amounts to $37,000, based on our assumptions. Now, so this is what you're forecasting based on these assumptions. This is where you can enter in what the property was doing, what it was the last 12 months of operating expenses. This will be useful so that you can then compare what the property was doing compared to what you are going to do after you get your new renovations and your team implemented. And the last thing I wanted to show you on this page is we have the ability to add expenses as a percentage of revenue as well. And so let's say we have an operations manager here, and in the prior year, let's say the prior company was paying 2% of revenue to an operations manager, a property management company for some function, and 1.5% of revenue for general and admin expenses. And let's say we are going to take that in-house and maybe have an employee as an operations manager, a salaried employee, and so we're not going to pay a third party a percentage of revenue. So we've set that to 0, but you can adjust that, as you'd like. Finally, you can set a reserve for replacements here over the years, just a reserve cash for replacements, HVAC systems, that sort of thing. Okay, now let's move on to our input salaries tab. So let's say that here we can enter in our prior year annual payroll expense. So this is what the prior owners were paying, $120,000 a year in payroll. We think we can operate the property with one facilities manager making $80,000 a year, start month 1, ending month 120, which is the end of the model, the 10-year model. And we're going to have just one of this particular employee. They're going to get a 2.5% raise annually. Now we can move on to, there's a couple more tabs here, our input financing tab, and then our input purchase and renovation budget tab. And these two things are kind of a circular reference. So we're going to be kind of going back and forth between the two, trying to figure out how to make the numbers work. And that's what you'll be doing, is you're working to find, how can I make the financing work? How can I get the debt and equity financing I need in order to acquire the property? But at a price point, how can I do the construction or renovation and the acquisition at a price point that will work, right? And so we're going to start on the purchase and renovation budget here. We've got set in here a $7.5 million purchase price for the property. We're saying start month is 2, end month is 2, meaning month 2 of the model, that's when we are purchasing this property. And we are also there's some existing furniture in the property that we're going to go ahead and pay for as part of the acquisition as well. So we've got furniture and fixtures, $20,000 per unit. So we've got $20,000 worth of furniture and fixtures in the 10 units here for a total of $200,000. And then down here is where we're going to put in our renovations. So let's say we're going to spend another $20,000 on some additional new furniture. We're going to have renovation hard costs of $50,000 per unit. So we've got all 10 units here. Plus here we're going to have just a $30,000 renovation hard cost budget for the entire property. So we've got 50,000 times 10 is 500 plus the 30,000 for the total property, giving us a total budget of 530,000 here. We're going to do some small upgrades to the parking lot, 25,000. Then we're going to hire a general contractor and foreman for 100,000 to kind of manage the renovation project. And now we can spread these expenses out over time. So some of these, like let's say these renovation hard costs are spread out between month 2 and month 8. All right, so all of that will ultimately tell us, okay, here's our total purchase and renovation cost of $8,375,000, or a cost per square foot of $244. So now we need to see, can we actually get the financing we need in order to make the acquisition and complete the renovations? So if we come back to the innovation or to the financing tab, we're going to say, okay, what is the debt service coverage ratio that the lender is going to require of us? And we're assuming a 1.25 debt service coverage ratio, a 6.5% interest rate with a 30-year term. Now, based on how the property was operating from the prior owners and that debt service coverage ratio, the prior year net operating income was $41,740 a month, which means at a 1.25 debt service coverage ratio, you can afford a monthly loan payment of $33,392. That loan payment over a 30-year term at 6.5% means that you'd be able to borrow $5.2 million. And so you might be able to fight with your lender to say, no, we want you to lend to us based on what we think we're going to do after we do make the acquisition, implement our own plan, drive down vacancy rate, increase rent rates, all those things. You might say, hey, lend to us based on that instead of based on how the property was operating. They may not do that to start with, right? They may want to lend based on how the property is currently operating. So this is kind of how it's currently operating. I think you might be able to get $5.2 million. I mean, you're going to need to come up with the rest as equity. However, once you get your renovations done and rents increase and all that sort of thing, and the property is stabilized, so we can see here in month 17, we're saying it's stabilized at kind of that new level. You can see that our average monthly net operating income is up to $61,000, up from $41,000 now to $61,000, which means we can afford a much higher monthly loan payment, meaning we can borrow more. So we're saying based on these, once we get the property up to speed, we can actually handle a $7.8 million loan. So the idea here might be you've got to come up with the equity to fill the gap for a short period of time. You get the property up to speed, and then you do a cash out refinance where you can repay some of that equity investors in the short term. Okay, so based on these assumptions, we're going to come down here and say, okay, we're going to borrow mini permanent debt here, mini perm debt in month one to make the acquisition of $5,775,000. And then see, this is less than this number. So we're in good shape. And then we're going to, in month 19, once things are stabilized, we are going to refinance. And since this model says, hey, you'd be able to borrow $7.8 million, we think. So we're going to borrow $7.5 and pay off, refinance the remaining debt, plus have some cash to be able to return to investors if that's what we want to do. With each loan, you're going to have financing costs. And so we have set up these financing costs to be a percentage of the total loan. So right now it's at 2% of the total loan you have entered up there. You can, of course, change all of these financing costs. And then finally, down here on the equity piece, we need to enter in our equity. And so, let's say you are going to put in $550,000, of your own cash, and then you're also looking for another investor to put in the remaining $3 million that we need. And so in total, we're going to raise, have 3.55 in investment. So you can see here with the $5 million in debt, 3.5 million in equity, we'll have total financing of 8.6, and our purchase and renovation budget's 8.375. We have 15,000 other fixed assets and 178,000 in financing costs, leaving us with 56,500 in working capital to be able to operate the property. And so this is saying, yes, we have sufficient working capital. Now, let me just show you, this is all green, meaning, hey, we've got the magic formula here where we can afford to acquire the property in it. Okay, so you're going to want to make sure that everything here is green and that that you have sufficient working capital. And the model should kind of yell at you in red if your numbers are off in some way, or you're not meeting certain ratios. It should tell you, hey, you don't have sufficient working capital or that sort of thing. So with all of those assumptions in mind, let's go back to this input distributions real quick. And what we're going to see here is that right now we're saying the company is keeping 100% of the cash and it's just holding it in reserve. And based on that, we're going to get a 16.7% IRR after we sell the property in year 10 at a 7 cap. Well, let's say, we did this cash out refinance. So let's say we don't really need to hold all this cash in reserve. So let's say we're going to only hold 50% of cash in reserve, which means the other 50% we can distribute to investors, which means we're going to distribute. You can see these estimated distributions then based on that required cash reserve. And that is going to increase our IRR significantly. So you can see the value of, doing the cash out refinance and paying back those investors earlier provides a higher IRR on the project. So anyway, hope that's been helpful. I know there's a lot here. So again, if you need any help as you're going through this, reach out to us at support@projectionhub.com. The other thing I'll just mention again is a thank you for listening to the very end of this. We have put a link in the description of the video below to a form that you can fill out. So if you fill out that form, it's going to email you a discount code that you can use, a coupon code that you'll be able to use at checkout to get a discount on this template as a thank you for sticking it through with us here. So hope that's been helpful. If you have any questions, we'd love to hear from you. Thanks.